So, what if I told you that some of the absolute richest, most successful investors on the planet literally do not care whether the stock market goes up or down? I mean, just imagine that for a second. The market completely crashes, they make money. The market soars, they make money. It sounds impossible, right? Like some kind of Wall Street magic. But it's not magic, it's just math. Welcome to This Explainer. Today, we are demystifying quantitative finance. We are going to go on a pretty fascinating journey together, transforming the absolute chaos of the stock market into beautiful mathematical order. And we're going to do it by looking closely at the actual, real-world models the pros use. Okay, here's our game plan for today. Part 1, finding order in chaos. Part 2, the pair trade strategy. Part 3, scaling to a portfolio. And finally, Part 4, beyond the basics. All right, let's jump right into Part 1, finding order in chaos. Think about looking at a stock chart for a major company. Let's say Apple in 2024. It is incredibly jagged. It's totally unpredictable. It starts the year falling, then rises sharply, goes flat, spikes again. I mean, how do you possibly model that kind of unpredictable, jagged line with math? You can't just draw a simple straight line through it. And this brings us to a really fundamental divide in the investing world. You see, traditional investors often pick stocks based on, a hunch, and their entire strategy relies completely on needing that jagged price line to go up. But quants, they have a totally distinct, objective-driven mindset. They use heavy math, massive data sets, and AI to turn those market swings into profit, absolutely regardless of the direction the market is moving. So, the absolutely crucial question is, how do they tame that wild, jagged chart? Well, they do it by completely changing what they look at. Instead of obsessing over the absolute price of a stock, they look at the return. Now look, finance is completely full of intimidating jargon, but there is absolutely no need to overcomplicate this one. Return is literally just a fancy word for the percent change in price from day to day. That is the whole shebang. And honestly, this brilliantly illustrates why changing our perspective matters so much, because if you take all those seemingly random daily returns and just drop them into a histogram, something incredible happens. This beautiful pattern emerges. If you look across major tech stocks in 2024, we're talking Nvidia, Meta, Google, Amazon, you don't see chaos anymore. You see the famous bell curve, tall in the middle, near zero, kind of tapering off at the ends. It's called a normal distribution, and guys, it is the absolute secret to finding order in all that noise. This builds our mathematical foundation perfectly, because a bell curve really only needs two numbers to fully define it. First, you've got the center of the curve, which is the mean, and in finance, that represents our return. Second, you have the spread of the values, or basically how wide that bell is. That is the standard deviation, which we casually call risk. It's incredibly elegant, right? We've basically translated visual shapes directly into the concrete concepts of risk and return. Moving right along to Part 2, the pair trade strategy. But, how do we actually use this mathematical foundation to, make real money? We're going to set up a little skirmish between two individual stocks to see exactly how we can capitalize on the mathematical relationship, the correlation between them. Now, to do this, we have to understand a tool called short selling. Let's break down this intimidating jargon really quick so you can see exactly how quants profit when things completely plummet. Short selling just means you borrow shares you don't even own and you sell them immediately for cash. Then you just sit back and wait. If the stock drops like you thought it would, you simply buy those shares back at the new, lower price, return them to whoever lent them to you, and you get to pocket the difference. Okay, let's walk through this chronologically with a real example to make it concrete. Imagine two companies. Let's call them Alpha and Omega. Our math models predict that Alpha is going to outperform Omega. So, step 1, we start by shorting 25 shares of Omega, which brings in exactly $1,000. Step 2, we immediately use that $1,000 to buy 20 shares of Alpha. Did you notice what just happened? We literally haven't put up a single dime of our own money. Step 3, we wait 3 months. Now, let's say the whole market crashes, and both stocks drop by exactly $5 a share. Finally, step 4, we close out both positions. Now, here is the absolute aha moment. Look at the final math. Remember, both of these stocks dropped by exactly $5. Alpha went from $50 to $45, Omega went from $40 to $35. But look closely at the percent change. Alpha only dropped 10%. Omega dropped 12.5%. So when we sell our Alpha shares and buy back our Omega shares to return them, we actually walk away with a $25 profit. Seriously, even though literally everything in the market went down, alpha technically outperformed omega in its returns exactly like our models predicted it would. All right, part 3, scaling to a portfolio. That is the absolute magic of the pair trade. But here's the real challenge for you. How do we scale this brilliant, tiny two-stock strategy up to an entire universe of companies, like all the stocks in the S&P 500? This, my friends, is our ultimate boss battle, 125,000. To model 500 stocks with a massive, multi-dimensional normal distribution, you don't just need 500 means and 500 standard deviations. No, you need to understand how every single stock relates to every other stock in that group, and that requires calculating nearly 125,000 individual correlation values. And right here is the glaring, massive problem that quants face, a huge data shortage. Think about it. There are only about 21 trading days in an average month. For 500 stocks, that gives us just 10,500 daily returns to work with. You cannot reliably calculate 125,000 correlations from just 10,500 data points. You literally do not have enough data to solve the puzzle. And this forces quants to build much smarter, highly efficient mathematical models. So how exactly do they organize this incredibly complex web of data? Well, through something called mean variance optimization, mostly using matrices. They bundle all 500 of those expected returns into a single list called a return vector. Then, they cram all the risk and all those correlation data points into a massive 500 by 500 grid, which they call a covariance matrix. And finally, the ultimate missing puzzle piece is the weight vector, which is really just a list of 500 values telling us exactly what percentage of our money to put into each and every stock. To find those absolutely perfect weights, we use an objective function. And this is beautiful, truly, because it perfectly mathematically represents human desire. It's a formula where we try to maximize the return, making it a positive term, while simultaneously minimizing the risk, making that a negative term. And we can even slap on a multiplier for risk aversion to basically tell the math exactly how much uncertainty we are personally willing to stomach. We are literally calculating the absolute best possible trade-off. But hold on, before we just let a Python script go wild and automate 500 complex trades in a matter of seconds, we have to give it some structural boundaries. We call these portfolio constraints. For example, are we doing longs only? Well, then all our weights must be positive and add up to exactly 100%. Are we doing a long-short strategy? Then, okay, some of those weights can be negative to represent our short sells. Or do we want a perfectly market-neutral portfolio where the sum of all the weights is exactly 0, perfectly balancing out our bets? The script needs to know the rules of the game before it plays. Finally, part 4, beyond the basics. That mean variance optimization we just covered, honestly, that is strictly the foundation. Today, quants at the real bleeding edge of the industry aren't just staring at stock prices anymore. They are tapping into incredible alternative data sources. They're feeding complex machine learning models with raw credit card transaction patterns to see consumer spending shifts in real time. They are literally buying mobile device geolocation data to track physical foot traffic outside of retail stores. They are spotting real-world economic trends before those trends ever even have a chance to hit the stock market ticker. It's wild. And some of these hedge funds, they bypass these complex prediction models altogether and just rely on pure, unadulterated speed. This is known as high-frequency trading, or HFT. These guys will physically place their own servers right next to the stock exchange's servers just to cut literal microseconds off their trade times. By being the absolute fastest in the room, they can exploit tiny, fleeting shifts in supply and demand, racking up microscopic profits thousands of times a single second. Ultimately, whether you are utilizing crazy alternative data, coding high-speed trading servers, or building beautifully balanced portfolios out of giant covariance matrices, the core mission of the quant remains exactly the same. Find the hidden patterns, model the uncertainty, and execute. So, looking at everything we've uncovered today, are you ready to turn uncertainty into profit? Thank you so much for exploring this fascinating world with me, and I truly hope this explainer has completely transformed how you see the market.